Now let's go ahead and discuss AMD. And I understand there's a lot of investors that are newer to the market that just got in the last few months, right? That don't really understand how to view something like this. So as somebody that's got 16 years of experience here and has millions of dollars of gains, right? Here's how I view, and here's a proper way to view a stock you're buying going down in the short term, right? Because I understand, like, newer investors, if you don't have much experience, you don't know much about the market, right? You're just kind of like, oh my gosh, like, what's going on? The stock's going down. This is bad, right? And you hear a lot of these bad things that aren't true or aren't accurate, like, catching a fallen knife and all these sorts of things that it's just complete BS, right? I love to catch fallen knives, and the far majority of the time I make so much money coming out of that. People are like, I wish I was there to catch that fallen knife with you, right? And so you got to understand how to view something like this. You don't view it from a context or a lens of like, it's going down, that means bad. No. If you guys watched the video I did last night on the main channel, right? I'm not sure if you guys follow me on the main channel. It's called Financial Education. I dove into those 7 stocks here, and I also discussed my price targets for those stocks 3 years out, okay? And what we found is when I ran my AMD numbers, I have that stock being over $400 a share 3 years from now. Now, even if it doesn't go there, let's just say 250, I still made over a double up, right, on my money. It's a phenomenal opportunity. The stock is a phenomenal opportunity. And so I'll take every share I can get my hands on right now at these sorts of prices. I gladly welcome them. I'm not selling AMD for several years, likely, right? So given that I'm not selling AMD stock for several years, and I'm trying to buy as many shares as possible, I would like my shares as cheap as I can possibly get my hands on them right now. Like, if you told me, would I rather have AMD be $115 today or $85 today, I'd rather have it be 85. Would I rather have it be 85 or 55? 55. Would I rather have it be $55 or 55 cents? 55 cents. Please give me AMD for 55 cents. Obviously, it's completely unrealistic, as $55 is as well, right? But you get the picture. I would rather have that stock be as low as possible right now because I'm buying as many shares as possible that are going to make me a fortune of money over the next few years, right? That's the way to view this. If I was buying AMD at $200-something today, it's not nearly as compelling of a risk-reward profile then at that point in time, right? So for stocks I'm planning on holding for likely several years, I don't need to have that stock be any. I would rather have it be much lower. Have me be on a loss right now. I have so many stocks with such insane gains. I don't need my ego stroked again by having another stock go beast in the short term. Go down in the short term. That's fine with me. If I need to stoke my ego, I'll pull up my portfolio and I'll look at Tesla and I'm like, 2,906% gain. Woo. I'll look at ELF, 1,700% gain. Palantir, 700. If I need to stroke my ego, I'll look at the $800,000 gain in Meta. I don't need AMD to be up right now. That's silly. So for any newbies in the market, right, that are trying to figure out how to really play this game on a high level, you shouldn't need stocks to be at a certain price in the short term. You, as a long-term investor, you want to buy these shares for as cheap as possible. So a year from now, 2 years from now, 3 years from now, 5 years from now, 7 years from now, you can sell them at massive profits, right? And then redeploy that money into the next great opportunities you see out there. And that's the market 101, right? And I teach all that in my private stock group. I get you guys, what I teach you in the private stock group, I teach you all the numbers-based stuff you need. Income statements, balance sheets, how to value growth stocks, how to value dividend stocks, all that stuff, right? But I also get your mindset right. And I think that's one of the biggest things that if you talk to members in the private stock group, that they'll say, he gets your mindset right. And really understanding how to view this game as a long-term investor to set yourself up for long-term success. And not just like this kind of like brain rot that goes on out there from folks, right? So, hey, it's Jeremy. I hope you really enjoyed that clip here today. Listen, there are 3 main areas a long-term investor has to understand. You have to understand financial statements, income statements, balance sheets, cash flows. You have to understand and master portfolio management. And you have to have the ability to project what is possible for companies in the coming years. Bearish scenarios, bullish scenarios. All these skills can be learned, and that's the good news. And I'm still just a regular guy who's out here. I just have a lot of passion for the market. I've learned a lot over the last 15 years. I had a tremendous amount of success, and I have a dedication to teaching people everything I have learned in the past 15 years. I can do it. You can do it too. You can learn all that's required to become a great investor in my private group. The application is going to be down there in the description area. You can click on that, fill out an application, join us in the private group, get access to all my best course curriculums, teaching you everything that I got in my head. And you get ability to join our 6-figure, 7-figure Hall of Fame. We have such a tremendous Discord. It is incredible. So once again, description area down there, there's a link. You can apply to join my private group in there.
So you're going to be sitting on quite a bit of cash in a very strong US dollar environment. So you've got a great currency behind you. You've got some money to deploy. Are you tempted by some of the other sectors around the world? Does Asia look cheap to you, or some parts of Europe? Is there anywhere you're thinking of deploying your cash outside the United States?
Yeah, I mean, we actually took some positions in emerging markets because we think all the rhetoric and all the fear around Donald Trump and tariffs, you know, it's funny when you hear people just sort of take him at his word at, oh my God, he's going to put 60% tariffs on China or whatever. And then they panic. And then you figure out, well, he's a businessman. And you've already had 4 years of this, where that's a starting point in negotiation. And where you ultimately end up is typically a lot better than that. So to your point, Mark, if you look at the relative valuations around the globe, yes, on a going forward basis for 12 months, the S&P is sitting at about 22 times or so. But if you look at some of these other markets, you've got the Nikkei sitting at about 19 times. You've got the Indian stock market sitting about 20 times, but the China stock market is sitting about 13 times. So a lot of these other markets have underperformed for the last 2-3 years. They're very cheap for obvious reasons. People are afraid of tariffs coming out of President Trump. But I think to some degree, and you saw that with some of the moves since the beginning of the year, is maybe they're a little bit overdone. And so that's where I'm looking, because the valuations, to your point, as you brought up, are a lot more compelling there. And then also in the US, the markets have really been driven by 7 stocks, the Magnificent Seven. And I think there's going to be an AI digestion phase. And we've been writing about this now for several months. And you're seeing signs of it from some of what Microsoft has said over the past month, which we can get into. But if that trade starts to fall apart, and given you've got 7 stocks that are somewhat tied to the AI trade that are driving the US market, that are 35%, let's say, of the S&P 500, and are trading at valuations in the low 30 times range, then you've got a huge problem potentially. And that money could also flow into these foreign markets that are a lot more hated, where the valuations are cheaper.
Dan, we'll pick up on AI and chips slightly later. Just to pick up on what you talked about, deploying your assets in markets, in Asia, emerging markets included. You talked about that low valuation in China. And as you said, it's low for a reason. Is it
So Dan Niles and myself, we don't always see eye to eye, but there's a lot of times, I'll be honest, him and I see eye to eye, right? For instance, last year, he was heavily invested in Meta and Amazon. Guess what? 2 of my top 4 positions are in the public account. Meta's my biggest. Amazon, I believe, is my 4th biggest, right? So, and then also, what have I been talking about for a while? Like, specifically with Nvidia. Growth rates are going to definitely slow substantially, at least in my opinion, in the back half of 2025, right? And that's going to be kind of a moment for people to kind of figure that out. And I think people are already starting to figure that out, even though it hasn't happened yet, right? But based upon kind of what Nvidia stock's been doing, it looks like people are kind of catching up to what I've been talking about for several months, right? About that cycle that's coming there, where it's going to be a major slowdown. People are going to be like, whoa, okay. Because then people are going to start to run with conclusions about, is Nvidia going to go negative on revenue? All those sorts of things will start to be talked about, right? Even if they don't come true and they don't come to fruition, it will just start to be subjects. They'll freak people out, right? Oh man, could Nvidia's revenues go negative? Because we know several times in the past Nvidia's revenues have actually gone negative. And so people will start having those sorts of discussions thinking about 2026, right? So that's going to be a whole digestion cycle like he speaks about. And so we definitely see eye to eye on that.
enough for you right now to be pumping money into that market?
Yeah, I mean, we own some stocks in there, but the thing with China, which makes it difficult, is 2 things. They've talked about in the past where handing out checks directly to consumers, they view it as a form of welfarism. rightly or wrongly. And they don't want people to get addicted to that. So you don't get this overstimulation that you've seen in markets like the US in particular, where they were handing out checks for people unemployed, or in Europe. And so you don't have that big bazooka effect, for lack of a better term, that will drive valuations and markets up on euphoria. And so any kind of recovery is likely to be a lot more measured. The second big problem, quite honestly, is the same one Japan suffered through for decades, which is there's only two real ways to grow the real economy, right? There's population growth, and then the productivity increases on that population growth. Well, in China, for the first time in 60 years, the population went down, and based on the...
Three, pump massive amounts of money into your... but then he said real, to be fair, but I'm just like, it could also grow that way too. Oh, gosh.
Traffic trends, they're probably going to go down for the next decade at least. And so much like Japan had to suffer through that, unless you get a massive increase in productivity, which given some of the restrictions on technology coming out of the US, it's hard to believe, those are some of the things you're going to have to struggle with. So for us, we picked cash as our top pick, but we have four other names. Two of them, Cisco and Adtran, are sitting in the telecom services space. We like the mid-cap stocks today. One of our other top picks, which is KBWB, which is the bank ETF in the US, that benefits from deregulation and tax cuts. So there are other names that we like in the US. We're just saying that it could be a very volatile year, and don't be surprised. And that's why we don't have a Magnificent Seven in that group of five, which we've always had one or two stocks in there. Last year, for example, we had both Meta and Amazon in our top five picks. We don't have one of those names in there this year because we do think there's some real AI digestion risk, and there's better places to deploy. And all of those names I mentioned, mid-cap value, the bank ETF, Adtran, Cisco, those other four names, they all have very compelling valuations relative to their peers or the market.
You like mid-cap?
It is interesting to see societies over time, viewing, let's say, people having kids as a bad thing, right? Like China had their one child policy for the longest time, right? That was a whole situation, and it was demonized if you had a bunch of kids in China, right? And it's just crazy for me to think about that, because it's like people having kids is the best thing for the economy. It's just there's no debating that. Of course it is, right? If you want to grow your economy, you want to grow your nation, you want to grow your country, what are you going to do? You need more people, right? If I had a choice, would I rather there be 330 million Americans or 660 million Americans? As an American that has a business, I'd much rather have there be 660 million Americans than 330. If we had 660 million Americans instead of 330, my YouTube views would probably be twice as high, right? I'd probably have twice as many people to sell 1000xstocks.com to. All that stuff, right? All my companies, all my stocks I own would have double the amount of consumers. And if you would just say, even if the GDP was the same, or not the GDP, GDP per capita, if you say the GDP per capita was the same, right? The average incomes were the same, right? It's just a massive amount more people to sell to. So, yes, it's always interesting, because I'm if anything, I think countries should be encouraging their people to have children, not... If you look at almost any society where they start to go into population decline, it's not a great thing for that country. It's not a great thing, man. It's the way it is.
Why not small caps? They also have compelling valuations.
Well, it's a great question, Haslinda. The big reason's the following. If you think about what I'm worried about, which is the Fed having to raise rates potentially as you get towards the end of this year, small caps struggle in that environment because they just happen to be smaller. And so a rate environment that's more beneficial to them really helps them out a lot more. And also, if the economy is slowing down, they don't have as much revenues to cover the fixed costs. If you look at the mid-cap space, by definition, they're mid-cap, right? So they're a little bit bigger. They can handle a tougher operating environment. But that's also why we say it's mid-cap value, not mid-cap, because mid-cap growth has also benefited from the same trends that have driven the overall market. And that's why we're saying mid-cap value is more interesting, because the S&P 500 over the last 5 years, if you think about it, first, it was a couple of years of investment during COVID because everybody's going online. So you have all this internet infrastructure spending happening. Then for the last 2 years, it's all been about AI. And so the S&P 500 over the last 5 years is up 82%. The mid-cap value space has underperformed that by 35% over that period of time and trades at a 17 multiple, not the 25 times trailing multiple that the S&P 500 is trading at. So, and you've seen this during 2022 when the Fed was hiking really fast, and quite honestly, during 01, 02, when you had the tech bubble break, which if it gets really bad in AI, I don't think it'll be that bad, but it could happen. That also held up very, very well. And so in a tougher environment, they also hold up nicely. And things like tax cuts and deregulation help the mid-cap names more than they're going to help the S&P 500 names, where they've already got low borrowing costs. They're huge. They don't care as much about that.
All right, Dan, it's Mark again. You were talking about the potential risk of an interest rate hike in the States. Well, we got one very much on the radar here in Asia. There's a lot of talk that the Bank of Japan could be raising interest rates next week, of course, from very, very low levels. Now, that may well give some support to the Japanese yen. Do you think that will work out in some way as a positive? People will be more attracted to Japanese markets because of a stronger currency, or is that going to be something which breaks the sentiment? There's been a lot of money rushing into Japan over the past couple of years. Is it good or bad if they have an interest rate hike next week?
Mark, you framed that beautifully. I mean, I always say it's never the data, it's the market's reaction to the data, right? Because if I tell you, hey, inflation's going to go up 6% over a year, you may go, oh my God, that's terrible for markets. Except if it's 2021, in which case the S&P went up 27%, right? So I think it'll actually be good for Japan, because the reason they're having to raise rates is maybe faster growth, some inflation. People really hate deflation, and Japan's been struggling with that for decades. And so I think in Japan's case, with the support, as you rightly pointed out, for the currency, if I were to bet, I think it's going to be more supportive for their economy versus negative. And so that's kind of how I would think about it as it relates to Japan specifically. The valuations, because the market has rallied so much from the lows, it's not hugely compelling at 19.
That's like a flash crash right there, man. Look at that move down. So dramatic, right? And then it just got right back to where it was supposed to be.
Versus, the China market sitting closer to 13 times, but it is lower than the S&P at 22. And obviously a lot, the AI companies for the most part are all sitting in the US. And so foreign markets by definition have struggled because of that. And the dollar, as you pointed out, relative to...
You don't play the Chinese markets or the Chinese stocks. Here's the issue. Those Chinese stocks and the Chinese indexes, they always look cheap versus US peers. Always looks cheap. Always looks cheap. Always will look cheap. Unless China makes some massive changes with transparency, with being much, much more business friendly, especially the top companies. Trust gets built a lot more. Like, outside of that, it will always trade at a significant discount to the US markets, and so won't Chinese stocks.
And the dollar by itself has gone up from 101 at the end of Q3 to about 109 at the end of Q4. And so that's put tremendous pressure on anything that isn't US based, right, for that reason. And so we'll see what happens going forward. But I think the way you framed it was perfect.
Right.
And I tend to be more on the bullish side on it.
Dan, this is a theme in the tech space, isn't it? I mean, that's what we're seeing with the Max 7 as well. They just keep bidding up the valuations.
Yeah, absolutely. And quite honestly, for the last couple of years, that's been the right thing to do because the AI trend has been so strong. But I think what investors should be concerned about is if you look at the biggest spender by far on AI capex, it's Microsoft. And part of that is obviously Microsoft has a 49% economic interest in OpenAI, which started this whole AI theme, which with their introduction of ChatGPT at the end of 2022. And Microsoft's capex has been growing at 70 to 80% year over year for the last 6 quarters, if you include December. But on January 3rd, they came out in a blog post and said, we're going to spend $80 billion on capex in their next fiscal year, which ends in June. But if you go and do the math, they already spent $20 billion in September quarter. They guided that up for the December quarter. And so you go, well, wait a minute, that means there's more than $40 billion in the first 6 months of fiscal 25, which means they're going to spend less than that in the next 6 months after growing 70 to 80% year over year for the last 6 quarters. So if you're any kind of chip company that sells into Microsoft or any of these other big hyperscalers, I think you're going to see a dramatic slowdown in revenues by the time you get to the middle of the year. And by the way, that's what you saw after all that investment during COVID. Because don't forget, Nvidia, which is the poster child for this trade, their revenues before COVID were negative year over year for about 3 quarters. And then COVID hit, and then the revenues surged to being up over 80% year over year by the beginning of 2021. Because we're all locked up, right? We're all going online. Then once we all get unlocked, those revenues went from up over 80% year over year to down over 20% year over year. The stock got crushed, went down over 60% during that move from peak to trough. And then you got the AI trade and you're back up to these levels. But I think you're going to see another slowdown after growing for 2 years over 100% year over year in revenues.
Dan, Nvidia is not in your top 5, but that doesn't mean you can't still make money with Nvidia. A lot of the guests that we've had on the show say that it is a must in your portfolio.
The one place I'll push back on the negative side for Nvidia is just because the companies, might not be growing as fast, let's call it by the back half of 2025, 2026, 2027, doesn't mean necessarily the company's going to go down on revenues. So I think if you're trying to price in revenues are going to go negative like past periods, I would be careful about that. And the reason being is Nvidia keeps launching these better AI chips. It's going to likely be year after year after year. And since we're in kind of a AI war over this next number of years, these companies are going to have to keep upgrading, right? So maybe they won't increase the capex as dramatically, but they still might have to increase at some point in time, right? And so, just be careful about betting Nvidia revenues going negative. I feel much more comfortable about maybe betting that their revenues end up evening out, maybe even more in the 10 to 15% range longer term, right? Obviously, 25 is still going to be a really nice growth year for Nvidia revenue-wise. But then after that, I would kind of think about Nvidia, maybe let's call it 10 to 20% revenue growth for the next number of years after that. AMD is a little different though. AMD, I really view that as a 20+% revenue grower for the next number of years, right? Because remember, AMD is playing a lot of catch up here in regards to this, where Nvidia's pulled forward a massive, monumental amount of demand.
Know that it's risen 800% over the last 2 years. There's still money to be had, right? Even if it's not going to be at the pace that we've been seeing in the last 2 years.
As I said, the last time you had to go through a digestion phase after COVID, Nvidia's stock went down over 60%, 60 from peak to trough. Right now, forecasts are for Nvidia's revenues to grow over 50% this year. I don't think it's going to be even close, because if you think about it this way, if your biggest customer is Microsoft and it's going from growing their capex 70 to 80% to basically 0 in 6 months, you've got to think through that, because all of these big hyperscalers, they kind of move together to some degree. Sure. And so if Amazon and Google, etc., see Microsoft spending slowing down that much. And by the way, it's slowing down for a good reason, because you're spending all this money. But the question is, have you seen any return on that investment?
Have you seen any return on investment? But that's going to happen with all of them. All of them are going to slow down. It's going to start in 25, and it'll slow even more in 2026. That does not mean they're going to stop spending. They're going to stop buying these chips, right? No, that's not how this works. But it will be a significant slowdown over the next 2 years in that spending, right? And the spending on capex, could end up being much more in line with revenue or maybe slightly lower revenue. So the way I would think about it is, let's just use Meta as an example. Let's say Meta is growing an average of 15% revenue per year for the next number of years, right? Which is a pretty fair number to consider Meta growing 15% a year revenues for the next, many, many years. So if that's the case, maybe Meta grows, capex in future years by 15% also. Or maybe they do a little less. Maybe it's like 12% or 11% or something like that, right? But in terms of this crazy capex cycle where it was far outpacing revenue, I think that's coming to a close on that chapter over this next 1 to 2 years. And then I believe it's going to be more in line with the company's revenues going up or less than what the company's revenue. So then if you got a company like Google, it might be growing 11% per year revenue. Maybe they start only growing capex by 7% or 5% or something like that, right? So that's the way I would view it.
So if you think about Microsoft in particular, especially given their relationship with OpenAI, when they reported the June quarter, they guided revenues below consensus for September, despite capex expectations going up. Then when they reported the September quarter, they guided revenues below expectations for December, despite capex expectations going up. So at a certain point, if you're not seeing the return, you're going to slow down that spending. And by the way, that goes for the other big guys as well, which is why I think you're going to see capex slow for the industry as a whole from growing 50 to 60% down into a 10 to 20% range. And I think Nvidia, I would be very careful on that stock this year. Now, it doesn't mean over the next, 3 years, 2 years, you can't see still growth. But I don't think anybody wants to go through a 60% loss like they saw after the COVID hangover. And you could see some very big downward revisions, especially when forecasts are for 50% growth for Nvidia's revenues in calendar 25. So that's why I think you have to be very careful of all of the AI-related stocks, because if Nvidia gets hit and there's an issue, everything's going to go down.
Yeah, I would be careful betting against, thinking Nvidia is going to go down 60% from here. I think that's really hard to do. In order to do that, you would have to have market crash. On top of that, like you did with the NASDAQ in 22, on top of that, you have to have their revenues go significantly negative, right? I think that's going to be hard to do, to get their revenues to go literally negative, okay?